The world may have dodged a full-blown meltdown thanks to China or Greece, perhaps, but what kind of damage, we ask, has already been done after these shocks to the system? James Sweeney is the chief economist and co-head of global economics and fixed income strategy at Credit Suisse. He explored that question in his most recent research note, A Faint Whiff of Panic. James is here with us in New York. James, a faint whiff of panic. What does it smell like?
Well, it doesn't smell very nice, but the smell has rapidly diminished in recent days.
Over the weekend?
Well, with the weekend and also with the stabilization of Chinese equities at the end of last week. The authorities are clearly hopeful that those declines will stop, and they seem to have stopped for now. And I mean, it looked like manufacturing globally was picking up a little bit in the last couple months, and we think it's likely to go on.
You pay close attention to industrial production, more so than other economists. Why?
Yeah. Because it's very measurable. It's very measurable in real time, and markets tend to overreact to the news. And actually, I wrote a note earlier this year showing that even the Fed overreacts to the news. The ISM index is, if you're on a desert island and you need to predict the Fed, the ISM index, which is mean reverting, is actually the best thing to predict what the Fed will do next in terms of interest rate changes since the early 90s.
Really? So if I'm on a desert island, I might want to take sticky fingers, a bottle of scotch, and the ISM.
Yeah.
Sticky fingers. That would be your choice?
Yeah.
I would take Cornell 77.
Let me get a close second.
Let me get back.
I'd bring a boat. But.
Let me get back. Good point. Let me get back to China. How much does it matter that the government there has put an artificial floor under prices of a still incredibly overvalued market in a country where growth is so hard to measure?
Yeah, well, I mean, I think the Chinese equity market isn't particularly easy to measure. It doesn't have a great free float, meaning the shares for most companies are not very publicly available. I mean, the short-term thing is you can't have the equity market falling by huge percentages week after week. If stocks are going to go lower over the next year, over the next 2 years, fine, but you don't want to have a full-fledged panic in the near term. So I think if authorities have helped to prevent that, then that's a good thing. Maybe
by disallowing you to sell and suspending all the companies that trade.
Well,
I mean, if that's a prevention of a panic,
well,
it seems that would cause a panic to me.
It's better than forcing me to sell my house because I've lost so much money on my equities.
But
but you'll have to sell your house because you can't sell your equities. If you need cash, you've got to sell something, right?
Well, yeah, that's the problem.
Here's the longer-term question about China's government actions on the stock market. If it's clearly not a free market. And so I guess my question to you is this. How important was the development of the Chinese equity capital market to the domestic demand story that China is trying to create?
Well, statistically, it's almost completely uncorrelated. Short-term moves in China's stock market have had very low correlations with Chinese growth and with global growth.
No, I was thinking in the medium to long term. In other words,
yeah.
China needs to create a place where capital looking for a home can find, companies that need capital.
Sure. And I think longer term, they're trying to have more of a price mechanism for allocating capital in the economy, and I think they're moving in that direction. The IPO boom that you've had in the last year is a signal of that. But, whenever you get those kinds of changes, you're going to have booms and busts potentially in the very near term. The interesting thing about this bubble is, if it is a bubble, is that it only began at the end of last year. It was very brief. So in a way, a collapsing market might not hurt as much if the market only had a few months to go up in the first place. So
that's a good point.
James, thank you.
Okay.
Great seeing you as always. James Sweeney of Credit Suisse, his most recent note, a faint whiff of panic.